Today was a very interesting day because CROX actually saw their share price decline by approximately 15% after they released their Q2 earnings. And the question I have is, does this provide us with an opportunity to purchase these shares, which appear to be undervalued, trading at less than 10 times earnings? That's what I want to investigate in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now let's dive right into this one because I feel like this is very interesting. This, full disclosure, is a name that I had purchased previously and I had sold, made some money on it last year, and now it looks like it's coming back down to a reasonable price level. But I have to say, before I get started, nothing on this channel is ever a recommendation. Always speak to an investment advisor before you make an investment decision, just to make sure if it's right for you or not. That's very important, guys. Okay, let's get into this. So you can see that the earnings were actually down almost 15% today. And, my question is, were the earnings that bad, or was the market just expecting too much? And I am kind of leaning on the latter. And for those of you who haven't really been following the story, recall that this actually isn't the first time that the stock dropped by double digits after earnings. Notice that in Q1, the stock also took a huge tumble. In fact, it took a larger tumble than the stock price today, actually. And so, investors, I think, have just built in a really high expectation. I just don't understand how they justified $150 per share price, unless, of course, they're expecting, I guess they're valuing it with less of a margin of safety than I would be. And so I understand, actually, I'll take that back. But, I would suspect that in an environment where, China is starting to slower, the rebound isn't as strong, and there is some, market uncertainty, I would expect that you'd want to buy a retailer's share price at approximately 50% of its intrinsic value, or closer to like 70%. I don't think that I would price this or be interested in buying it up to, this $140, $150 per share range. I don't think we're in that economy anymore. So I just felt like there was a lot of optimism built into the price. And so, if you're buying it at 150 and you expect it to go to 300, I think you were a little bit overly optimistic on this name, which is what I think has happened. And so you can see this was actually the first to decline. So this was the decline in Q1. And so, they did go in the news report that came out on April 27th, and they said that while the footwear manufacturer beat Q1 earnings expectations and hiked full year forecasts, Q2 estimates disappointed. That is an extremely silly reason why a stock should sell off. And what it speaks to is how much optimism was built into the name, where the company beat earnings expectations and then they actually increased their full year forecast, and the stock still declined. That's actually crazy. And the stock didn't just decline a little bit, it declined 20%, which shows to you how you might actually have a group of crazy investors in this name. But listen, I like crazy because that's how I can make some money. If Mr. Market keeps losing his mind every time CROX increases its guidance and smashes through earnings estimates, then that sounds like a recipe for profits for me. And so, today what happened, CROX actually tumbled 15% after their earnings showed some weakness at their Hey Dude brand. Now, this headline says or suggests that there's some real problems here, but I'm going to go into this article and I'll show you how in their own article they disprove the headline. And this is what I mean, or not necessarily disprove it, but it's not as terrible as the headline suggests the situation to be, at least in my opinion. You guys let me know if you disagree with me in the comments. I love when you guys have differing opinions than I do, because it really helps the people that watch these videos and then they go in and read the comments. There's a lot of value there. And so here's what the article went on to say. Wholesale revenue for Hey Dude fell 8.4% following pipeline fill in the same period of 2022. Okay, fine. But notice that the direct-to-consumer sales were actually up 30%. And I'll actually show you a chart that shows this whole thing. Now, here's the thing. The company expects full-year revenue for Hey Dude to grow to 14 to 18%, down from their previous guidance of the mid-20% growth. Now, here's what I would offer here, that if you forecasted growth in the mid 20% range, I just think you're a sucker because you're pricing this thing for perfection. Anytime management is giving you, or at least in my opinion, anytime management gives me a mid 20% growth expectation, I will just take the 20% and then apply 75% against that. So like I wouldn't even take the 20%. I would be forecasting somewhere in the 14 to 18 already before they even let me know of that. So it allows me to hedge my expectations. It allows me to be very conservative in the way that I'm building out the model. Yes, I miss out on opportunities that I understand often, but I'd rather buy something where I believe it's next to inevitable that they'll reach their goals, stepping climbing a set of stairs just one step at a time, as opposed to leaping over huge hurdles. And so that's the way I forecast and model out companies. You guys let me know if you guys just take what management says. And especially after 2022, where a lot of management teams were bringing down their growth estimates, their guidance expectations, you would think that investors would have learned by now, but it seems like people just continue to make the same mistakes over and over again. And this has been the same story for the last 20 years, at least since I've been in the markets. And so, the company's wholesale partners are pretty cautious in the back half of the year. They should always be cautious. It's not an issue that we should be worried about in retail. Look, things go up, things go down. It's not a straight line. And so that's why the valuations have to reflect that. Retail is a very tough business. And so, here's what management said. They said, I think the wholesalers are being cautious for 3 reasons. One, they're just cautious about overall traffic trends and the trajectory of the consumer. That's fair because we're in a very unpredictable market right now. Second, they've got some overstock in some other brands, principally some of the big athletic brands that they're going to walk through. Okay, fine. And then finally, they don't have good history on Hey Dude in the back half of the year. Okay, fine. But that doesn't necessarily mean that if they're seeing sell throughs like increasing sales to the consumers at the wholesale level, that doesn't mean that they wouldn't order more later on. Hey, look, it sounds like it's a very temporary issue as far as I'm concerned. And if they're all if these are some of the issues that are existing, but they still expect to grow between 14 and 18%, I just think you just taper your expectations and then go from there. And so this can still potentially be an interesting opportunity if the investors are just a little bit more conservative in the way that they're forecasting this. And I will show you, I'll walk you through how I'm doing it. Now, here's some really, really interesting news. And I mean, if you've been following the story, you would know this, that, after they bought Hey Dude, they've been changing the distribution model to bring it closer to the one that they have for CROX, which is a direct to consumer, but also online as well. And so once again, the fact that some of their former distribution partners are offering the product at a discount on Amazon, which is putting pressure on the company's efforts to attain full price sales at their other wholesale level, it just seems like it's a very temporary issue. It looks like that that product will eventually run out, and then this pressure doesn't exist anymore. And that's kind of what they're saying here, where they're saying that, Reese, their CEO, says that the amount of product is finite and it will run out. And so the company is also expecting distribution capabilities to be constrained in the second half as it transitions to a new ERP system. Fine, another temporary issue. It just doesn't seem like there's any sustainable issue that would permanently impair the growth trajectory of the business. In fact, if you move to a better ERP system, I would suspect that would help them optimize inventory levels a lot better and optimize for growth better as well. But we'll see how that plans out. They often don't tell you all of the benefits of new ERPs. I wonder if an analyst asked the question. I'll take a look at the Q&A to see if there was a little bit more detail on this. And ultimately, the thesis remains the same. The Asia growth strategy continues to bear fruit. And notice that the growth trend has not declined. So on a trailing 12-month basis, they're still up 47% year over year. Now, do I expect this to decline a bit? Of course I do. There's weakness in China. And so, can it come down to 30, 20? Of course. But overall, I just think that the long-term trend continues, and I believe that their focus on growing in Asia makes a lot of sense and is working. And let's talk a little bit about Hey Dude. So here's the interesting thing about it, that, if a 27% sell-through growth rate is a bad thing, then I just think that the market is nuts. And that's just my opinion. And so, they're telling us that they estimate that Hey Dude's sell-out grew by 27% during Q2. And you can see the one area that's holding back the growth is the wholesale sellout in their non-strategic accounts. So the question is, why are the non-strategic accounts lower in terms of growth, going backwards than their direct to consumer and their wholesale for strategic accounts? Well, the truth is that they just stopped selling to them, so they can just sell less. So in 2022, they began to open strategic US wholesale accounts and eliminate non-strategic accounts. And so this is why the non-strategic wholesale segment is down 20%. So you just have to take that into consideration. Is this a long-term issue? I don't think so. In fact, you can already see that their strategic account is high. Now, you put those two together, obviously you get a worse number. But once again, it just seems like a temporary issue. I might be missing something here, but you guys let me know in the comments below. Now, I just had to re-jog my memory on the retail terminology, but just remember, they use the term sell out. And so what they mean by that is it's the number of units of a product that the retailer ends up selling to the end consumer. So if the supplier is CROX and they've sold in and through to, and the distributors have sold through the retailers, what they're really trying to measure is how much have the retailers sold to the end consumer. And so if that's growing significantly, which once again, they say right here that the sell out grew 27% during Q2, that's a healthy sign. That's a really healthy growth measure, because the last thing that you want to see in terms of growing through the channel is that you're seeing growth by stuffing the channel, but you're seeing actually a slowdown at the sellout phase, which is the consumer phase, the ultimate buyer of the product. So the fact that the ultimate buyer is up 27% year over year is a good news story ultimately for this business. Now, what I want to do next is get into the modeling for CROX. So what you're seeing here is the tracker for all of the securities that I track. You can see I've grayed out all the other names. There's actually names behind here that look just like CROX. So there's just a bunch of cells above and below. And notice here that CROX is very close to the top of the tracker. And the reason why that is because the share price has come down 14% today, and it came down 20% previously, or just a bit more than 20% previously. It's down, call it 45% or whatever it is. It's gone much higher on the tracker, which essentially tracks lists names on share price as a percentage of their intrinsic value. And so the lower the share price is as a percentage of what I think its intrinsic value. And here you can see that, my modeling is forecasting their intrinsic value to be $191. Now, that's not a price target for you guys. You guys decide yourselves what you believe that the company is worth. This is just my opinion of what I think it's worth on a conservative basis, at least. And so, the 102 divided by the 191, you're close to that 50% range. And what that really reflects is a very low P ratio of 8.9 times earnings. And if you turn that upside down, 1 divided by 8.9, it reflects a pretty healthy equity yield of 11.3%. And so, what this tells me is anytime these stocks, and this is actually why the tracker is very useful, because every day as stocks move up and down, as Mr. Market gives us opportunities, the tracker actually auto captures it because it'll automatically move the names up or down. And so this is how I catch these opportunities as they occur. And so, this potentially means that this could be an interesting opportunity that I enter into once again, or at least I start thinking about entering into once again, because it's not a name that I currently own, in full disclosure. Now, the other thing that you get access to when you access the trackers, you can actually link into the stock analyzer tool, which is, free for you guys. And then you can also link into the options calculator tool. In the next video, I'll actually show you how I think about the options for this. But also there's a time for the monthly call that everyone gets access to at the higher tier. And this is what I mean. If you want access to the tracker and all of the models that are connected to the tracker, you can join us at this lower tier. And if you want to join us at the higher tier for the monthly calls, you also get access to special live courses and a comps schedule, which right now there's a comps schedule for the regional banks, which I found very useful, especially as I was investing in quite a few regional banks. In fact, regional banking is my number one, actually it is my number one exposure right now, and it's done pretty well over the past couple of months. This comp schedule is what I used to assess the regional banks against one another and decide which ones were right for my portfolio. And so you get access to that work as well. That took, a couple weeks to do. So that's a lot of work that you get access to in that comp schedule. And, there's approximately 200 or so of you guys who are a part of the team right now. And, we don't have a huge turnover, which just speaks to how much value there is, especially at the lower tier level. But I also feel that the best value is at the higher tier because, you can speak to me directly every month. You get access to the courses and, of course, the comp schedule, which I think is very helpful. Now, with the tracker, you can actually click on the CROX ticker symbol, and then it'll take you into the model. And so what I wanted to first start with was what the historicals look like for CROX. So you can see, like many retailers, they really had a post-COVID surge. You can see that, 2018 was low, and then it kind of doubled again, and then it just surged in 2021 and 2022. And so, in my eyes, this makes it a riskier thesis, but it's kind of because, what happens in a post-COVID environment? Do things go back to normal? But I think, we might actually already be in normal for CROX because, one, you have that acquisition of Hey Dude, which of course automatically just keeps revenue at a certain level, but also they've been geographically expanding. They've been adjusting their channel distribution as well and expanding their channel distribution opportunities by going omni-channel as much as they can, leveraging relationships with key retailers, but also just optimization of their business as a whole, which also includes optimizing their store count, which is a strategy that they started back in 2017. And, it's all bearing fruit. And so, some of the labor that was put in 2018, 2019, you're starting to see it really pan out. And I think I think overall you've seen a turnaround story here. And this is what I'm talking about. This is their story, and it came from their Q4 deck, and you can see that they admit that they overextended between 2002 and 2013, which caused problems. But post 2017, they really turned the business around. So here's what they're saying: they overextended their global retail fleet to 600 plus stores in 2013, and there was no cohesive global marketing strategy. They were really high in cost. Their SG&A was 47% of revenues. But now, what they did, and you're seeing a similar story play out with Foot Locker right now. Foot Locker's kind of in this transformation and brand reignition phase, I would say. But, the first thing that they're doing is they're shrinking the revenue, or they shrunk their revenue to a lower a more profitable level. Andrew Reese was brought on. They shifted, or I guess he was appointed as president. They shifted their their marketing to a digital only strategy. And then, of course, they started leveraging influence and partnerships. I think here's what really helped them. They introduced seasonally relevant graphics. Also the partnerships, collaborations really helped. And then, of course, they focused on cutting expenses. And look, they reduced store count by more than 200 stores, and they focused only on profitable outlets. That obviously helped them. And then, of course, they in 2018 and beyond, you started seeing them achieve double-digit operating margin targets and expanded their adjusted margin to 28%. They repurchased a ton of shares, and then they outlined their strategy for going global, which I think is a thesis that still resounds to today, and I think it's making a lot of sense, and they're showing that it makes a lot of sense. And then, of course, they made that acquisition of Hey Dude. So the why am I showing you that? The point of showing you that is I'm trying to get across, at least in my opinion, my belief that you can't look at this business pre-2017. I don't think that business remains anymore. I think you got to look at this business 2017 and thereafter, and then make a decision. Does this turnaround story really still exist, or are we going to go back a little bit? Now, one of the things that you could do is, you can use option strategies to bring your net purchase price significantly lower, just to sort of hedge yourself, just in case if the business does go backwards a little bit. So you can do some things like that just to provide yourself with a little bit of protection. And that's more of like a cautiously optimistic strategy if you want to make money on the same, if it makes sense at the prices that you get or the premiums that you generate on those options. Now, just jumping into their 2023 guidance, you can see that they're looking to grow revenue still in this year. You would think that with a 20% decline in Q1 and a 15% decline after reporting Q2, that they're going backwards in the year. No, they're not. They're actually sticking to their guidance. Their prior guidance was 11 to 14. Now they're saying they're going to be growing 12.5 to 14.5. So, I mean, there's nothing significantly different here. And on the bottom line, notice that their guidance is actually higher. So, the stock is actually down on higher EPS guidance for 2023, which is absolutely nuts to me. And, it's not like they're spending more money on CapEx or whatever, right? And so, they're going to make they're expecting to make $4 billion in revenue for fiscal year 2023. And thus the guidance ultimately has not changed materially, which is why the way that the stock is behaving is kind of nuts to me. And I know some of you guys watch my videos when you're at the gym. I hope this is big enough. I'm really sorry if it's not, but you can see here the 39999, that's their $4 billion in revenue that they're expecting to achieve in 2023. And, obviously they can get higher than that. They can get to 14.5. The one thing that I do want to point out is they haven't talked about this lately, but in 2026, management was guiding to $5 billion of CROX sales and $1 billion of Hey Dude sales. So $6 billion potentially in 2026. I never forecasted that amount. So this is what I mean about being conservative on these names. Just because management is super optimistic doesn't necessarily mean that we have to be, right? And so, after 2023, which I give them credit for at the lower end, I actually took their growth down to 7.5% every year thereafter. If the valuation made sense at this conservative level, I would consider it. Now, the other thing that I did to be more conservative on this name is, look, they actually are looking to achieve a higher operating profit margin, even more so than what I'm predicting for them. I'm predicting 26.5% operating profit. They're saying that their adjusted operating margin is expected to be 27.5%. Now, that's an adjusted number. This is a GAAP number, so there's a natural difference there. But, in 2024, you can see that I'm definitely below where I believe that they think they're going to land. And so I'm at, I've increased SG&A to 30%. So, my GAAP operating profit margin are at 24%. So I'm once again handicapping my valuation, and it's being done on purpose because I don't have to believe or buy into what management is forecasting here. And so ultimately, what does that mean for the valuation? Well, using a terminal discount rate of 11.5 and a terminal multiple of 15, which I think is reasonable for the name, I'm valuing them at around $221 per share. However, you guys know how I feel about debt. And if I were to buy the whole company today, the first thing that I would do is wipe out all of that debt. And so the way that I personally value companies is I penalize them for the debt taken, and this is I penalize them for debt. And so this debt is the amount of debt that they took for the Hey Dude acquisition. It is a overhang on the name, and it's the reason why a lot of value investors don't get into the name, because they believe that it has a lot of debt. I actually don't think it's a significant amount of debt. I think they have it well handled. However, what this does is it brings my valuation down by $30 a share. So I'm valuing it at $191, which is what you guys saw previously, because this is where the tracker links to. And so you'll just see in the tracker that it'll just link to this cell in the CROX a specific valuation page. And then of course the current share price is $102 per share, which reflects an 18.9 times multiple and a 11.3% equity yield. And obviously my valuation is just it's reflecting 16.6 times next year's earnings, but part of that, it just reflects the growth in the name. But ultimately, I'm suggesting that the company's trading at approximately 50% of its intrinsic value, give or take some of the handicapping that I've done in the actual numbers. Now, just quickly jumping into the balance sheet, this is also in the model that you guys get access to when you click into the CROX template or the CROX link. And so here's what I'm talking about the debt expanding. And so notice that in 2022, the debt materially increased. I mean, it did increase in 2021 as well, but this was that Hey Dude acquisition. And so you really have to consider that when you consider the valuation for the company, at least I do. And it's not like the management team doesn't know that we're thinking about this and we look at it as an overhang on the security. Look, you don't want debt with retailers. Retail is a risky business, right? And the only way to not go bankrupt is not have debtors come after your business. And so that's why I actually prefer that they bring the debt down to zero. And I ultimately think that, in my humble opinion, it's a mistake to even have a long-term debt target. But notice that, they had a 3.1 times a net leverage ratio, and I believe that that's to adjusted EBITDA. And obviously it's come down. Partially that's because earnings have gone up, but notice that they once again have a long-term debt target, and they're very close to that. This is 1.8. They're looking to 1.0 to 1.5. So it looks like by the end of the year they might actually get there. They're saying it's long-term, but I don't know how they don't get there by the end of the year. I haven't done the math, but it just sounds like, just look at the trajectory, right? But notice that they've already started repurchasing shares again in Q3 of 2023. It was a small amount, but yeah, it's they started repurchasing. Now they've repaid $850 million of the debt since the acquisition. But honestly, once again, I would love if they paused the share repurchases. They don't have a dividend, which is great, and they just brought the debt down to zero. I would this would be a fantastic opportunity if they committed to bringing the debt down to zero. And I would potentially consider doubling any position that I inevitably enter into. If I do decide to enter into it, just really depends on what the price is. But if I was going to put a certain portion of my portfolio, would I double it if they were doing exactly what I'd hoped that they would do? Of course. Now, one of the arguments against paying down that debt is, of course, that they can use that capital to continue to grow the business. I get that. But maybe because it's a long-term target, they could just say that the long-term target is zero, but over the near term, this is what the near-term target is. So that's kind of the way that I want to see the messaging. And so, I really hope somebody from the company is watching this video and they do, inevitably suggest that they do want to bring the debt eventually down to zero. I would love to hear that, especially with a retailer. The business is just tougher. And so ultimately, that is what I think about the name. In the next video, or in the next couple of videos, what I'm going to do is I'm going to investigate the option strategies to sort of bring the risk down in this name a little bit more. Because it's retail, I generally am very hesitant. I tippy toe into these positions and I look for a lot of security. I would love to buy this at around 5-6 times earnings. Right now it's at around 8.6 or so. And so just an insane amount of margin of safety. But that's just me. I'm very cautious. I tend to be very pessimistic. I think part of that is just, investing through the 08, 09 time period where things got really tough. And so that's kind of shaped the way that I invest now. And I tend to always be almost hyper conservative when it comes to valuations and entering into the positions, but that's okay. The right pitches do come to me, and they come to me often. They definitely came to me in 2023. I was able to deploy a lot of the capital. I'm no longer at 70% cash. And so that's all good news. And so you guys let me know what you think. Are you guys buyers of this name, or are you waiting for the price to come down even more? Let me know in the comments below, and I'll leave it there for you guys. But also, if you guys missed my latest video, no problem. You can get to it right here.